A very good afternoon to ladies and gentlemen. My name is Dinah Opoku. I manage the sales and I'm manager sales electronic channels and payment systems for Republic Bank. This afternoon, I'll be moderating this session on reforming banking and microfinance, mobilizing local capital to strengthen inclusive finance. I'm doing this with this awesome lady and gentleman here. They will introduce themselves and they will quickly dive into this conversation. Thank you. Yes, sir. Can you introduce yourself and tell us what you are currently doing in this space?
Okay, good afternoon again. Oh, good afternoon.
Good afternoon.
We are here. Let's be happy we are here. My name is known already. As Chinubu Akodia Boache. I work with the non-bank sector. In Ghana here, when we say the non-bank sector, typically under the banking structure, is when you take away the commercial banks, all the other players fall within this space. Savings and loans companies, finance houses, microfinance companies, rural and community banks, credit unions, susu collectors, microcredit, financial NGOs, leasing companies. We want to put all these things. We have an association called GAMFIN. So that is the umbrella body. And I am in charge of one of them, that is the savings and loans and the finance houses. And typically, we are for the MSMEs. And so you will find all the non-bank institutions all over the country, everywhere. And so this conversation we're having actually sits right. And actually, the central bank has also introduced some reforms within the space, which I'm sure we will have the opportunity to also speak about as to how it ties into building a bigger, better ecosystem. Thank you very much.
Sana, can we hear from you?
Thank you very much. And my name is Sena Dake. I'm the immediate past president of the Institute of Chartered Accountants, Ghana. I currently work with the Young Chartered Accountants Network that we are building to have a group of experts who are chartered accountants, but not only in the accounting field, but experts in different fields like development finance and entrepreneurship, IT, and stuff. Whilst doing that, I think my recent passion has been with helping organizations integrate ESG into their business streams. And I think it fits well into the topic we are coming to do. Thank you.
Good afternoon once again. My name is Kwabena Boama. I'm the Managing Director for Stanbic Investment Management Services Limited. We pride ourselves as being one of the leading asset management firms in Ghana. But more importantly, from 2016 till now, we have led the pension allocation into the alternatives, trying to ensure that we play a significant role in the real sector from 2016 till now.
Thank you. So you can see that we have a solid panel for this afternoon's discussion. Now, over the period, we've had rural and community institutions supporting the SMEs. Banks have done their part. There's been some BOG reforms trying to merge banks, regulate them. All these have been in attempts to make the institution firm to support these SMEs. But when you look around, you see that SMEs are still staggering. And that is what is informing this afternoon's conversation. We began in the morning, and we are continuing this session from here. So let me start with you, Mr. Chunibua. What are the immediate implications of the new regulatory reforms for savings and loans companies and microfinance institutions? How can we relate this with what's been happening all day here?
Thank you very much. The central bank in January released some reform guidelines. And this has had a history that we saw as a country. There is the need for us to harmonize and bring together the operations of these smaller financial institutions so that the regulations can also be appropriately tiered towards these institutions. So we started a conversation by putting in place a policy. And currently the policy is at the ministry level waiting for cabinet approval. But one of the components of the policy direction has to do with reforming the whole industry. And that is why the central bank released this reforms. And what does this reform seek to do? One, it seeks to now bring clarity in the categorization of the institutions that play within the financial space. One, either you are a community bank, in that case, you are going to have banks established by communities themselves. So in that case, communities will be able to mobilize their own capital and then build their own financial institution, not in the hands of one person. Then the second category has to do with credit unions. So the central bank is also now enforcing and building that system, making sure that they are also well-regulated credit union. Now, credit union is for individuals who will come together to do bid on their own. Then the third category has to do with microfinance banks. So now when this reform starts in earnest January 2027, you are not going to have savings and loans companies, finance houses, microfinance company, or microcredit company. All these four institutional types are now going to be called microfinance banks. So they are going to be banks called microfinance banks who operate everywhere in the country. What does this reform also do, apart from bringing clarity, is to also build stronger, better, well-governed institutions so that it will not be left in the hands of one person. So the central bank has raised their capital so that when you come in to take deposit from the public, you have better systems. Again, the reform is also geared towards making sure that the customer that we do business with is well served, and then systems are also put in place to also manage risk management so that our focus of helping MSMEs grow, we can also achieve that mandate, and also to make sure that investors have value for their investment into the space. So this reform is changing the face of microfinance banking in Ghana.
Thank you. Great insights you share with us. We're happy to know that community-based banks will be coming in, and then microfinance and banks will be coming in to strengthen this space. Let me come to you, Kwabna. From an asset management perspective, how do the recent reforms in banking and microfinance change the attractiveness of the sector for institutional investors?
Right. I think I'll take it from two approaches. One from what we look out for as far as investment guidelines are concerned with pensions. And then I'll piggyback on what Chunebua shared on the reforms. So one of the key points from the pensions space is to preserve capital. So then the question is, do these reforms give us the assurance that investing in these microfinance institutions, our capital will be preserved? The second one has to do with low default risk. With the reforms that have taken place, will we have the comfort that these entities are now well-resourced, well-capitalized, and are able to make the appropriate provisions so that we know that when it comes to default, we are not going back to what we saw in the past? Another key area which he stressed on was the governance. We are to ensure that we invest in companies that have strong governance. And in line with that, we're looking at well-regulated entities. Then the last one has to do with stable and predictable returns. So once we give monies to these MFBs, we want to make sure that these monies can come back and they will also get the returns. Now, will these reforms be attractive? It looks very good on paper. I guess the challenge will be the implementation of the reforms. The increase in minimum capital makes it good for us to start with in terms of they being fully resourced, and I guess that helps even with the human resource infrastructure to be able to provide the necessary operational governance to do what they do, proper risk assessment. Then also, in addition to the capital reforms, which gives us comfort, we're also looking at stronger governance. And we like the restrictions around even the ownership, which allows for proper board representation. And then also the proper fit for proper tests in terms of who is on the governance. Once these reforms are able to achieve these, it will give us the comfort that we can actually allocate capital to the MFBs. And then lastly, on this one, we're happy about how the central bank is approaching this. And I actually am more comfortable about even the change in the name. Now we are talking about microfinance banks. So in a sense, it's giving us a bit of comfort around how the central bank is going to pay more attention to these entities. And that, I believe, makes it attractive for us to look at.
Thank you. I'm excited you talk about an effective risk management system, because over the years, that has been the major challenge SMEs have faced, and resulting in them having access to adequate support and funding. Let's move to Senna. Senna, how can we enhance SME access to microfinance through the financial integrity and accountability?
Yeah, thank you very much. I think the starting point goes with the quality of the SME's financial information. And then also having honest people to work with. That's the integrity part of it. But seriously, we can have so many ways, but I'll just group them into 5. So the first part is how we can provide quality financial information. One of the things that came up in the earlier session on the threshold for companies to have audited accounts, I think this has not been very much known by many organizations, that the companies regulation LI 2473 has provided some classification that exempts and waives auditing of financial statements for some category of companies. And the small companies or micro companies have been categorized 400,000 and below. And then in addition, if you have a staff strength of 50 and below, you are exempted from having an audited financial statement. Between 400,000 and 10 million cedis, you have a limited review required. And that's to use a ISRE, that's the review engagement standards, not the full IFRS. But beyond 10 million cedis, you are expected to have your accounts or financial statements audited. So that's the first thing of educating a lot of SMEs about this that they can take advantage of, because some of them may still be spending on auditing of their financial statement when they probably don't fall in that classification. Another very important thing is digitization. The use of fintech has become something that we need to embrace. For SMEs that are in our communities, we really need to see the POS, you really need to see mobile payments, even transactions being invoiced virtually is something that can really pitch the access to finance, and not only relying on credit, but increasing your revenue from what you do, not only depending on the credit aspect. So whilst doing that, I think the overall fintech for me and for the accountants would be that we need to adopt the IFRS taxonomy. Now, the IFRS is the International Financial Reporting Standards, which have been set globally. Ghana does not have a unique one. We are applying the global one, and by the Companies Act, we are expected to adopt it and implement it. Now, since 2012, we've been using the IFRS, and it's even now time for us to look at the impact that it has been made so far. And I think the Institute of Chartered Accountants is doing a research on that. Whilst doing that, the next thing is the taxonomy is an XBRL or machine-ready information where it provides easy comparability, a single source of information. It provides competitiveness, and the industry providers are able to relate. Let me just break it down this way. When you are filing your returns at the moment, you file using a PDF and just upload. But when we start using XBRL, you would enter the information directly, your turnover directly, and put the amount as input. So the output that comes, it will reflect at GRA, reflect at ORC, reflect at BOG. So in fact, it becomes an easy source of information, a single source, instead of the inconsistency in information, which is provided for access to capital. I think I'll just add 2 more points for us to be able to save time. So adopting this taxonomy is very important. Another thing is the credit governance. We've heard a lot about the credit governance so far, but it's also time for us to look beyond the interest and see responsible lending, responsible business, looking at integrating certain bits of ESG into the work that is done both at the regulatory perspective and at the regulator's perspective. The regulatory perspective here, we are expecting that there will be the social impact of whatever they are doing will be visible in their reports. And so even though sustainability report is not mandatory for SMEs at the moment, it's important that when they want to pitch themselves and get access to certain capital, they should still have some elements of their responsibility in certain areas, the environment, how their materiality or the double materiality issues can be reflected. Maybe lastly, I want to add that SMEs are overwhelmed at the moment. There is too much regulation, guideline here and there from different regulators. ORC will bring its own, GRA will bring its own, and all over. So if you are even a PIE, then you also have a specific or specialized regulator. So can we harmonize? Can we have a higher collaboration? Can we have a situation where instead of having different financial information being provided, that one-stop shop will be provided by the SME and every regulator can feed into it? That is the reason why I feel today it's all should be taxonomy. Thank you.
Thank you, Senna, for the brilliant insights you share. I am excited that we have all these graduations in place for the different levels of SMEs to access funding. We here have access to this information. I am hoping that we will have a channel for this information should get to the SMEs for them to know that today's businesses can access funding through these means. Interestingly, the harmonization also comes into play. Like you said, they are overwhelmed. We are hoping that this will come to solve it. Prof, you're welcome. Let me come to you. What role can development finance institutions play in crowding in domestic capital to undeserved sectors? What role can development finance institutions play in crowding in domestic capital to undeserved sectors?
Thank you. Thank you very much. Yeah, I think they can play a number of roles in a sense that for a development finance institution, often they have a unique mandate. Their mandate is to ensure that they provide a much more patient capital that the mainstream banking sector will usually not be able to provide. And so for a development finance institution, what they often will come in because usually there is what we call tenor mismatch, okay? There's critical market failure when it comes to access to finance because sometimes we say that there's broad access to finance, the microfinance institutions are providing access. But the key question is it just about access? Or it goes beyond just access to also include the usage of the facility and then the quality of the facility. These are the two main things. Yes, we do have a number of microfinance institutions now providing access to this MSMEs. But when you drill deeper, you realize that the terms the term structure of many of these facilities are inimical to the growth of these MSMEs. One, it often comes in a very short tenors, quick liquidity fixes. The interest rates are so exorbitant, it doesn't help them to grow. It doesn't come with any sort of support, technical support, or even grace period, moratorium, and nothing. It doesn't fit into the business cycle of of this MSME. So for a development finance institution that has its eye on impact, the main thing is to make sure that the facility is serving a better purpose. It's meeting the needs of these MSMEs. And therefore, you are not just providing access, you are making sure that the right tenor is provided. If the firm needs short-term facility, you want to provide short-term facility. If it needs medium-term, you should be able to provide medium-term. If the business is such that they will need longer-term facility because of the cycle, the seasonality, or the gestation period of that business, you should be able to provide that facility. And then not only that, you want to make sure that sometimes we don't look at the rate of returns of these businesses. We just price. And so many of them take the loans, but in the end, they become so indebted because even how much the amount of money they are getting back is not enough to repay. Right? So you want to make sure that you match also the returns, okay, with the returns on the business. So the loan facility should be concessional in nature, should be able to meet the needs and then the expected yield from that business. All right. So we are very much focused. Development finance institutions try to close that gap. The gap that the mainstream will normally not look at because they are very much profit-oriented. They are looking at quick returns, to their facility and all of that. But a development finance institution will want to make sure that it's not just about providing access, it's about the quality of the financial services and then the usage, how well you are using it to benefit your business as much as you can, right? So in a nutshell, that is how a development finance institution. Beyond that, the development finance institution also provide knowledge capital, which is critical, the capability and then the technical support, because many of these businesses do not have the technical know-how, the ability to manage their business in such a way that it becomes self-liquidating. They are able to repay back the loan in time. They are able to manage it in a way that they ensure sustainability, financial sustainability of the business. And therefore, they need support. They need hand-holding support. So as a development finance institution that has not just a debt lens, but it has a system lens, looking at it from end to end, you do not just provide lending, you want to make sure that you also provide technical assistance. Okay? You do hand-holding, you provide knowledge as much as possible so that not even for your own financing, but to also unlock other more financing, because you then de-risk the sector as much as possible as a result of the capacity building that you are providing. And that should be the role of the development finance institution.
Thank you, Prof. Now, we know that we owe these SMEs some financial advisory services when they come in, so that if they come in for short term and we think that the longer term facility will help them, we guide them to assess those type of facilities. Thank you so much. Mr. Chunibo, let me come back to you. Do you see consolidation in the sector as a threat or an opportunity to build stronger institutions?
I will say it's rather going to make things better. Why? When we look at our market and the data from the central bank, you realize that in any of the sectors, talking about community banks, savings and loans, microfinance companies and all that, the top 10 of each of these sectors are actually controlling about 80% of the market. And they have customers all over the country. And so how do we make sure that the customer is well served? So the central bank coming in with this reform is to say, if you really want to mobilize deposit from the market, then you need to have better, stronger financial institutions. So that, just as Kwabena said, they will feel at home to even partner with these institutions to say, I am investing in this particular institution. So, to a larger extent, normally I always say that the reform is very good, which we should embrace, but it's the implementation. If people really understand the reasoning, that it is also giving communities the opportunity to actually run their own banking institution, like the community banking concept, then it's going to now open up the market. If you go to the US and other markets, you will realize that majority of these banking institutions are community banks. But in Ghana here, just last year, 2025, you'll take only the savings and loans companies. They actually disbursed in excess of 13 million loans. When I say million loans, 1, 2, 3, 4, 5 loans, 13 million loans. And it was in excess of about 15 billion. That is only the savings and loans. So take the rural and community banks. They have more than 12 or about 11 million customers. So this is an opportunity for us as a country to say, what can we do better? Again, we need to also now look at the financial education aspect. You see, most SMEs, and from morning the conversation has been, the money is there, the capital is there, but why are the MSMEs not getting the money? If the funder says the money is there, why are the people not getting the money? Why? One, education is low. We are not educating people enough as to what they should do to be able to tap into the capital. Two, data, documentation, records keeping is also limited. So these are some of the things that the reform under the microfinance policy, we seek to build what we call the microfinance fund, 1, 2, capacity building, and 3 has to do with even credit rating. It is one of the key things that we're building out of this reform. And the last thing I will touch on has to do with how do we as a country make sure that there is a policy alignment. You see, Ghana, we like bringing one policy, we will be going here, and the following day, there's another policy to just push us to the other side. How do we make sure that these smaller institutions who are now stronger, well-governed, well-managed, can even tap into long-term funding like the pension funds? There are some savings and loans companies who are on the alternative market who have these medium-term facilities. And those people are able to give 2-year, 3-year, but not we using short-term facility to give long-term loans. So we all have a role to play, and we believe that the future is better, brighter, to make sure that the MSME that we say we exist for them, they get the benefits from it. Thank you.
Thank you. I think that in connection with what you said, Senna also had mentioned that there are POS transactions and other means of accounting should be used to assess them, and so it's a step in the direction.
Let me add this, that
briefly.
There is actually a project that we are now bringing all these non-bank institutions on one platform where they are able to participate in the payment ecosystem at a reasonable rate so that they can now serve their customers everywhere in the country. And this project is being supported by the Central Bank and GIPS so that everybody, all our customers are able to take advantage of the opportunity in the payment space.
Thank you, Chinebua. Very briefly, time is not on our side, so Kwabena, what would it take for fund managers and pension funds to allocate more capital into inclusive finance and microfinance institutions? Very briefly.
Right. I think that the fund managers will not be the major issue. It will be the trustees that we will have to recommend the investment to make a decision. But this is the case. Some of these trustees did invest in microfinance institutions and didn't get their money back. So I think for me, the first hurdle is dealing with the fear of history repeating itself. We say that nya owo akanedano, some of them bought Anglo Gold many years ago and have refused to invest in shares. So the fear of history repeating itself is what we need to deal with from day one. And then two, on the DFIs, I think there's an easy way for them to play a critical role. They should come in with guarantees. They shouldn't deploy their capital. Provide guarantees for pensions to invest in these microfinance banks. If they do that, it will be easy for us to do the assessment and then do deployment into these MDFIs or microfinance banks. And I think that will provide the track record, and subsequently they can remove the guarantees over time, and we will do the assessment and then invest. Then again, the level of compliance with the reforms will be critical for us to make an investment case to the trustees. So it's all well and good on paper, but how practical will it be for these entities to comply with all the requirements and the reforms, resourcing their management, the capital requirements, governance, which we spoke about earlier on. And then also lastly, for me, the quality of their asset books. I think we'll be moving away from small, informal finance, risky entities to more or less smaller banks, which will be well managed with proper risk measures. If we're able to do that and they prove on paper and in practice that their books are equally filled with quality assets, I think it will be attractive for us to invest.
Absolutely, thank you. So now let me take you quickly and go to Prof. Our time is almost gone. What role should accountants and auditors play in ensuring institutions are investment ready and compliant under the new regulatory framework? You having the accounting background, what's your view?
All right, thank you very much. I think we need accountants and auditors as trusted advisors. Take a case where somebody needs a loan, goes through a laborious process and never got the loan on time. And then because the loan got ready when he didn't need the money, would have to still collect the money, but use it for something else. In such a situation, it's really somebody who is technical, who could also advise and help the person to separate their personal money from the business money, or even avoid misapplying the money. That could make a difference for that organization, because definitely there may be defaults on that. The other thing is that auditors provide assurance, and that assurance builds confidence for investors and even the customers and employees, knowing that there will be some audits and then there will be opinion, and so it's good for auditors to keep doing that. But the bottom line is that financial literacy, which we've spoken about, should not just be said. It needs to be practicalized. Please, when you say you see the agric extension officers who are helping the farmers now, these are professionals. They are experts in their field. How much do the farmers have to pay for them to help them? They go to the farm, they go to the hinterland, they go through the mud, and when they are doing that, they do that for free based on some projects and support that have been given to them. So is it not possible that even if it's not on a large scale, through maybe impact investment, for instance, we will have a pilot of 100 companies, SMEs, across a certain number of regions, and that pilot, an investment will be made to buy the XBRL, to give them a license for maybe 3 years, that can you give it a try? And using the young chartered accountants or those who are not too old or very in big firms, maybe avoiding the big firms, using them to do the process of bookkeeping for these SMEs, to practicalize them and make sure that they are also getting that kind of service which they yearn for, they can't afford. That kind of investment is what we need now, because SMEs truly cannot afford XBRL. But the large companies can. Apart from talking about this, I think South Africa has done it. It came and started from the central bank, and central bank just said all banks and depositors should have, but depositing institutions should have XBRL reporting. And they gave a phased approach. Between that time, 2018 till now, we have about 35,000 institutions that are filing their returns using the XBRL. I think the XBRL is a way to go, that's a taxonomy, and we may need investment, maybe through the investments, impact investment again, or any other institution of repute to go to further that. Maybe lastly, I want to add, because of maybe my background in ESG, that we are avoiding the ESG integration. We are talking about it, but we are not doing it. When you go to the market, even to a watch seller now, and you always get your mat in a foil or in a rubber, and then there is another person who opens a shop just next by and starts packaging in a paper, or even using the leaves, banku in leaves. How do you feel? You feel more attracted to buy that one in the paper. That is what is happening to businesses. Businesses are losing little monies because the integration of ESG is not being taken serious. We need to advance it and be able to start reporting on it. Thank you.
Thank you so much. Thank you. Let's take the last one from Prof. very briefly. What would it take to fund managers and pension funds to allocate more capital into inclusive finance and microfinance institutions?
What would it take? I think for us as a development finance institution, what would take will be the institutional capacity, to absorb that capital. More often than not, we found out that there's often a misalignment, in terms of the mandate. Because for a development finance institution, it's not just about lending, as I mentioned earlier. It's more about impact that you are looking at. So if the funding is going into the key sectors, the critical sectors of the economy, if the fund of fund or the fund management are also akin to the development-oriented idea and will be channeling funds into areas of the economy which will bring about economic transformation and impact, then we are very much aligned. Okay, so you want to ensure that the funding goes into the areas that are of importance to the economy, areas that will generate a lot more employment, areas that will empower women, that will bring about inclusiveness, areas that will ensure sustainability and climate-friendly related investments, right? And so if we see that alignment, why not? We definitely would want to provide funding, to such a fund manager to be able to, extend credit to these key sectors of the economy. The institutional capacity is also very important. We just spoken about ESG, because many development finance institutions, are really very much into ESG, as a center of excellence, ensuring that the funding, is not going into areas that will further harm the environment and all of that, and ensure inclusiveness and in closing the inequality gaps and all that. So if the fund managers are also aligned, definitely it's going to, attract funding. And then lastly, and more importantly, is the governance structure, the corporate governance structure. How strong is the corporate governance structure? Do they have well-established governance structure in place that will ensure, accountability, that will ensure responsibility, that will ensure transparency on how the money has been invested, right? If these are available and the DD points to alignment, definitely, they are able to attract funding, from other DPs and development finance institutions.
Thank you so much, Prof. I think that in this light, we owe it a duty to be monitoring these funds that are availed to the SMEs, and to ensure that they are actually channeled into the needs they apply for. And once they align and the financial institutions align, we're likely to grow, since we agree that SMEs create a lot of jobs. A lot of women in our country today are into SMEs, and so by doing that, we will be growing the female sector. I am happy that today I sit here, there's another woman on the panel, so I'm keeping a balance, even though we still have a 3-to-2 ratio. It's a good number. And so when we do this, SMEs will bring in more women as we anticipate. So at this point, I want to share this with all of us. We have been here since morning, so I don't want to leave this to the panel. I'm throwing it to all of us. What actions need to be taken or are being taken in our organizations or others in the space to make sure we are mobilizing domestic financing for inclusive finance and not leaving anyone behind? And this is to all of us here. Our panelists have been talking all day, and so I throw this to all of us. If a panelist wants to take this up too, you're welcome. Can anybody help us with the microphone going around? Yes, sir. Could you please pass on the microphone? Thank you.
Good afternoon.
Good afternoon.
My name is Percival Ofori Ampoma, Venture Capital Trust Fund. To respond directly to your question, what actions are we taking? Venture Capital Trust Fund has been at the forefront of mobilizing capital.
Great.
And we do that through the public-private partnership, in that when we put money on the table, we expect that the private sector will put money on the table as well. We've done that for the last 20 years. So since 2004, when the act was passed, every one Ghana cedi that we put on the table, we've got 5.6 Ghana cedis of private sector money coming in. And the reason we've been able to do that is because we've always insisted on private sector discipline. A few minutes before this panel, the Honorable Member of Parliament was here, and he outlined many of the difficulties that come with programs like this. And of course, one of them is that the execution or how you disperse the money becomes a problem. And so right from the start, we decided, let the private sector lead, which is why private sector fund managers are managing the money, licensed by SEC. Private sector pension fund money comes in, which means we are imposing private sector discipline. So that's what we are doing. Now, let me just comment one on the gentleman who said there's a lot of money. I heard that in the plenary session as well. And we've been saying that, but please, I would argue here that it is not entirely true that there's a lot of money everywhere. That is a recent phenomenon. What we are saying is a recent phenomenon. It's recent because now, when you go and put your money in the bank, they are giving you 5%. They are giving you 10%. And when you lend the money to the government, they are no longer giving you the 28%, 30%. That is crowding out private sector money. Banks were taking money and simply buying treasury bills. It's much more lucrative because rather than going to do a due diligence on an SME and give that money to them for them to default, yesterday I learned that the NPLs have gone to about 18.7, significantly high. They would rather quietly give it to government. The CEOs would enjoy their big bonuses. Kwabna and his colleagues will be laughing. So it's easier, which is why they were not doing it. So if 2-3 years ago, SMEs would have been going to the banks or anywhere, or even pension funds, were asked to put money in anything other than government bond, they will say, come tomorrow. But today, things have changed, which is why we are hearing there is a lot of money, there's a lot of money. It's a recent phenomenon, and let's not overemphasize that. There are still rigidities that we need to deal with in order for SMEs to get access to these monies. When we're talking about making sure SMEs are well prepared, we know that when SMEs come to borrow or get money, you go through about 100 or 200 companies before you get one. Why is that? Why? Is there anybody helping them with bankable, becoming bankable? These things have to be solved. Then the government has to understand that it has to stay out of the market for the monies to flow to these companies. So that idea, please, I beg you, if anybody has a radically opposing view, please. But I don't think that there's money everywhere. It has never been the case. Now, maybe, but it's a recent phenomenon, and let's recognize that. Thank you very much.
Thank you. Percival from Venture Capital. Thank you for holding in for the past 20 years until we got funds just 3 years ago. We are happy you stood in for us. Is anybody ready to share a perspective? Just one more, and then we can go to... Yes, can we get one more? There's a hand here. Okay, we have 2 hands, so let's take this one. Oh, no. Take your turn. He can also take his. Thank you.
Okay, thank you. It's been a really interesting discussion. My question is, I guess, more to the Association of Savings and Loans Companies. And it's on the impact on financial inclusion with having bigger institutions and what that means for having branches that are closer to where people live, especially smaller towns where there may not be a rural or community bank yet. And there may be a current microfinance institution that is actually well run. But with these reforms, if it's not able to pull together quite a bit of capital of a scale that is so exponentially higher from where they are, that it would take more or less a miracle. In a market where we don't have a culture of mergers and acquisitions. So even when bigger institutions, banks, were given these higher requirements, it was very hard to actually have mergers and acquisitions. So my question, I guess, is what could the impact be on smaller towns that already have a footprint, and to what extent, I know you are savings and loans, you may not be microfinance, but to what extent are we mapping what this means for financial inclusion, and to what extent could there be space to keep some level of smaller institutions that are filling a need where no one else is and are actually doing it well?
Thank you. And certainly there is. I think Mr. Chinibwa would take this because he had mentioned about community, what did you call them? Yes, coming up by 2027. Is that correct? So kindly take this for us.
This is a concern to most businesses, the smaller institutions, but they are not actually going to be cut off entirely. Under the arrangement, the central bank says that if you will not be able to scale up, you can be where you are and scale down or remain that place. So the central bank calls it the last mile. So in that case, there's going to be a restriction on deposit mobilization. So what they will be doing is to help with credit delivery. So they are normally microcredit institutions. And then you also have the susu collectors also continue to do businesses. There is also going to be the recognition of these village savings associations, those who do ROSCA, the rotating credit and savings. There's also going to be a recognition of their businesses as well. Not that they are going to be regulated, but they will be recognized so that you know that these are institutions operating within the space. The next thing has to do with these bigger institutions should also be able to now reach out better. What I mean is that now they're able to operate and open branches with their own capital, not that of a depositor's funds. Because this is one of the things that were happening in the past, where people will come in with small money and use depositor's funds to just grow the business. So all these things are being discussed. And actually, the good thing about this whole arrangement is that we are still discussing the implementation. And just as I said, I adopt and accept the reform, but it's more of the implementation, which we are actually dealing with the central bank. And I'm very sure that by the time we complete the process, by the end of the year, We'll be clear in our minds. And I must also say, let's encourage ourselves to work together. If you have 2, 3 different microfinance within an area, yes, we don't like mergers. We don't like working with people. But that actually is also a false statement. Why? We have been doing Nobua all these years. We do communal labor. We do one farm, then we will go and do another together, and the following time we do this. Why not this? So I think we need to have more conversation about these things, and how do we make sure that there's patient capital. Patient capital. Thank you.
Thank you, Mr. Chinibwa. Do we have the last question?
Yeah.
Yes, so I'll take the last question. There's a gentleman behind in white over there.
Hello? Can I be
Can
here?
you pass on the microphone to him? Oh, sorry. There are 2. Okay, so brief.
Yeah. Right. That will be very brief. We spoke about responsible lending to meet the SMEs or the entrepreneurs' needs and all of that. I mean, strengthening inclusive finance and all of that. But I'm struggling to put a finger on all of these things outside this room. And that is at the back of something I witnessed in one of the savings and loan banking hall just about 2 years ago. Not that far. A gentleman I work with over the period who is uneducated, sorry to say, but he looked up to me for advice. How do I grow my business? He's just an artisanal guy. Has built a very nice business for himself. So I advise him, register your business, keep proper books of account, do this. I even encourage him to hire a secretary who can help him keep records, ledgers here and stuff. Now, this guy comes to me and says he needs a loan to buy materials to scale up because he's getting contracts that he needs to produce for. Then walks into one savings and loan. They ask him to bring in somebody who's a salary earner to guarantee. And he's been calling me for over weeks. So one day I decided to just show up and guarantee for him, just for him to be, because he trusted me to do that. I walk into the banking hall, and the structure is quite funny. They don't tell you the rate you are going to pay on the facility. They tell you, we give you X amount, but then you're going to pay 534 Ghana cedis every week for 1 year. And this guy is unable to put paper down and calculate to see at the end of this payment, how much rate have I paid? Now I got into the bank just to go and sign this and go away. Then they told me that I was like, wait, let me do the math. And I realized that the guy is paying almost about 92% interest rate on that. I'm like, sorry, I can't guarantee this for you because this is clearly a suicide. You can't survive in this. But the guy's a very energetic guy. He's like, no, 500, I can't pay. Just sign it. I need the money. I'm like, no, I can't do this for you. So today, he's not even willing to answer my call for any angel investor. I'm trying to get him other alternatives, but he's not interested. I move into the manager's office to go and inquire, is that how things are done here? I almost got thrown out by security because I said, this is an extortion. Because how do you pay 92% on a loan? And these are the small, micro businesses. We try to groom them to become SMEs, medium enterprises, so that venture capital, private equity funds can just invest in them and scale up. And then at the very beginning, we are crippling them with 92% interest rate. And this is to Mr. Chinibwa. If you can address this, that's how things are done in your industry. Because
Thank you,
it's
sir.
an extortion, clearly.
Thank you. Let Senna take this because he touched on risk assessment. All this pricing you hear, this exorbitant pricing is due to inaccurate or, how do I call them, risk assessment. So Senna, can you touch on this for us? Thank you.
Yeah, thank you very much. And this is the point I was trying to make earlier, that we really need to engage professionals in assisting the SMEs, whether not just building their capacity, but hand-holding and giving them the opportunity to use the professionals appropriately. And this hidden interest, this hidden penalties, apart from the hidden interest, there are penalties. And I'm actually on a case in which the bank gave a loan, and then in the agreement, the loan agreement, is indicated that the bank has a right to change the interest rate without the consent of the borrower. And that was signed. And we are in court, and the lawyer, I feel ashamed because if the lawyers were engaged at the time of signing that kind of agreement, that shouldn't have happened. And the amount of interest was so high Now, beyond that, there is penalties. So this is a reality. And getting professionals to assist these SMEs is the number one thing which I've talked about, which I believe is just the time. This is the time for us to do that. The financial literacy on paper is not enough. Getting them in a big hall to talk to them is not enough. We need to practically help them. And let's give it a try. Let's do a pilot. Let somebody invest to just support a few people to help them. And if it works well, then it can work for a bigger chunk of people. Because when you compare Ghana and our interest rates of 21 to 22% to other countries like Kenya, which are about 12, or even South Africa, ours is way, way, way too high. And what makes us stand out? It's what we can do from now that will make it possible. Thank you.
Thank you. Due to time, we will take the last lot. This question goes to all of us. What is one concrete action or collaboration that stakeholders in this room can take within the next 12 months to advance this agenda? I mean, what we've been discussing all day. So I'll take the first lot and open up. So we are relating it to our institutions. I work with Republic Bank, and over there, we are giving SMEs a 45-day interest-free credit cards to assist them. We are also giving them 500,000 unsecured facilities. So that is what my institution is doing. I want to know what your institution is doing to support this agenda. Kindly throw in a few before the angel shows up. Yes, sir. Mr. Alexis Siedu, right? Thank you.
Well, very interesting discussions. And thank you, Republic Bank, for doling out the cash. And I'm not holding brief for financial institutions, but I've been part of a financial institution early in my career, and it was giving out subsidized funds by DFIs to entities on the market. And I remember very well having to go to collect a loan. I think that program was called Tipsy or so. And the guy who had taken the money just blurted out clearly, Sikai manjise mitria, enyamodia. So that's the other side of the equation. On the one hand, professionalism, doing the right thing. But we have a culture of not taking people's money and intending to give it back. And so collectively, with our institutions, we should make sure that there is education to let people know that when you've taken other people's monies, you also do your part of the deal, of the contract, and make it a point to give it back. But trust me, a large part of our populace doesn't take the money with the intent to give it back. And that's how come financial institutions behave that way. Because deep down, they are not sure whether the money will come back or not. So it's up to us. Let's go out and educate those who are taking the money. Thanks.
Thank you so much, Mr. Siedu. I think our time is up, so I want to thank you. Oh, there's a hand up. So this is our last slot, and then we can wrap it up.
Okay, thank you. So my name is Prince Ufoyi from Pong with Wanga Green Ventures. I had a question. I wanted to know, to what extent does the central bank intend to influence the capital allocation of these new banks that are being created? Because you don't want to wake up tomorrow and then central bank is saying that lending to locals are risky. So maybe 80% can go to treasuries, and maybe the remaining 20% can now go to loans to our local SMEs. Right? Yeah.
Thank you. Prof, will you take this for me? Or who can take this one?
Oh,
the last one.
Okay, just to be
Mr.
brief,
Tinubu,
the issue is that we are in a liberal market. We mobilize private funds and do business with it. The central bank cannot impose and say, you should not do this or you should do this. But the central bank use different instruments to also encourage the financial institution to do certain investment or invest in certain areas. Actually, ESG is one of the key things that now all the institutions, you have to make sure that even the facility you are granting complies with the ESG principles. The next thing that I want to just touch on briefly to say, I've written them here and I'm happy people have said. One, let's build relationship. If you want, you know you will build, you need a loan. Don't wait. Build relationship. Save with an institution. Build that relationship. There are a lot of savings and loans, rural and community banks, microfinance institutions. As of today, they are granting 18% per annum loan. So the general misconception that their loans are too expensive is not everybody. But how will you know? Because you are under pressure, you just walk to the nearest one and you go and they put it on your head. 2, pay your loans. Pay your loans. When you take the loan, it's somebody's money. Pay our loans. 3, don't chase interest rate. Ghanaians, we like chasing interest rate. Fortunately, the government has listened to the conversation of not crowding out the businesses by lowering its interest rate. We want to see that being seen in our attitude. The last thing is the government and DBG is here that we adopt the microfinance policy, which has a lot of things that is going to change the face of the industry. And I am sure if we work together, those smaller banking institutions within your communities, let us be the watchdogs. When you see they are doing something wrong, please report them. Report them, and together we will make the industry better. Thank you very much for the opportunity.
Thank you. On this note, I want to say a big thank you to our audience and our panelists for the insightful ideas they shared with us. Thank you so much.